start at the end of the week, Larry. We got the jobs numbers out for the United States, better than expected, pretty robust, not just for last month, but also revising for the prior month. What do you make of these jobs numbers?
Look, it fits what I've thought for a while now, David. We've got a very, very strong economy on the demand side and not a very strong economy on the supply side, and that's risking an overheating. You saw a lot of job creation. You didn't see an increase in labor force participation. You saw a rapid average hourly earnings figure, but if you adjusted for the fact that most of the people coming back were in leisure and hospitality where wages are relatively low, it was an even stronger wage figure. I think we're still not running policies that are consistent with the reality of the economy. The reality of the economy is that we've got an interest rate far below the neutral interest rate, and we've got a tight labor market. And that's a prescription for rising inflation, not a prescription for falling inflation. So I continue to be very concerned about the outlook going out a year or so as the economy starts hitting supply constraints and hitting them hard, given all the pressure on demand.
Larry, I wonder if there's a connection between two of the things you referred to, the participation rate on the one hand and the increase in average hourly earnings on the other. Because we've been saying, well, the participation rate went down from the pandemic. It's come back some, but it's not nearly where it was before. At what point, as that continues out, does that become a structural change that actually could have longer-term effects on inflation, particularly wage inflation?
So I think there are 2 points, David. The first is that until 2017, the Fed thought the normal unemployment rate, the natural unemployment rate, was 4.7% or more. So we may well just be there looking at the level of unemployment, and it's clearly headed down from here, not up from here. With respect to participation, I don't think anybody can gauge it. But if you take more mental illness, if you take some concerns as people reassess their lives, as you take a super high level of structural change in the economy, as you take some people because of their fears of COVID or their distaste for mandates moving away from work, if you take the early retirements that probably aren't going to be reversed, if you take the more generous child care benefits and apply the estimates the progressives have traditionally used, that's likely to have some discouraging effect on employment. If you take all that together, I don't think we've got a strong basis for thinking that participation is going to rally in a major way. It might not, it might happen, but for that to be the major planning assumption seems to me to be taking a big risk.
So, Larry, hook that up, if you can, with what we heard from the Federal Reserve this week, and particularly from the chair, Jay Powell. He certainly seemed to say in the news conference that really, when it comes to the question of tapering, he's begun, but particularly rate hikes, that's going to be determined by what happens with the labor force. Is he right about that? And is it possible for him actually to be too gentle in the messages he's sending to the markets? Because certainly the financial conditions did not tighten at all.
Look, what the Fed controls is financial conditions. If you look at financial conditions as measured by real interest rates, if you look at financial conditions as measured by asset prices, they are looser than they were before Jay spoke on Wednesday. They are looser than they were a month or two ago. We've got rising inflation and we're not tightening financial conditions. That's why I fear that we are on a risky course. Now, the argument that thoughtful people like my friend, former classmate Paul Krugman make is that there's some risk aversion principle that we've got to do this because it would be so catastrophic to run a recession, and inflation is a manageable problem. I agree that we've got to guard against risks, but here's my view. My view is if we let inflation accelerate, there's almost no proven ability of the central bank to engineer a soft landing. And so in order to squeeze out an extra bit of hoped for labor market tightness, I think we're taking a real risk that we're setting up for a very serious problem. You know, if you look ahead of you and you see that there might be all the traffic stopped, you start braking your car as early as you can, even if it means that it's going to slow you down in the event that there is no traffic jam. And that's, I think, the right way to think about the central bank's problem right now.
Larry, another big development through the course of the week was with respect to the bipartisan infrastructure bill, as well as the so-called Build Back Better plan. It's not quite there yet. It's not finalized, but we have a pretty good sense of where it's going. What do you make of what we're seeing, both on the what we're spending side and how we're paying for it side?
Look, I hope we get this done. I hope both bills pass, the bipartisan infrastructure bill and some version of the so-called reconciliation bill. There's sure a lot of effort going into building better, build back better, and I hope it works out. I also hope people are going to keep a very, very close eye on this, since at the very last stage, that's when abusive provisions or misprovisions are sometimes put in. I'm glad to see that the provisions on SALT deductions look like they're being modified somewhat. It would have been a real tragedy, David, I think, if the provisions had ended up being written in a way where people in the top 0.1% of the income distribution got a substantial tax cut. I think we're moving towards fixing that. But look, these are investments that our country should be making. It's also not too early to say that it's not the amount of money you spend and the nobility of the cause you spend it on, but it's how well you spend the money that matters. Are infrastructure projects going to produce a better infrastructure, or are they just going to help the businesses that provide infrastructure services? It's going to be really important, both in terms of the effectiveness of the investments and in terms of the American people's confidence in government, that this money be spent well as being spent on a significant scale.
Larry, one last one. Last week, you and I talked about the COP26 talks, which were upcoming in Glasgow. We've now had them. You expressed some concern, even doubt, last week that they would be able to do enough to really get us on the course we need to go. Did they?
I'm still worried, David. You know, I learned as a fundraiser that when people wanted to say a really polite no, what they would do is talk about a much longer horizon and a much more ambitious goal. And I felt like there was a fair amount of that going on in Glasgow. And I'd like to judge things a little more by what people are actually going to get done and committed in the next 5 years, rather than the aspirations they're going to set for decades from now.
It's such an important lesson. Just briefly here at the end, what do we need to do to have concrete things to be done in the near future?
I think how rapidly we're moving to, in a very supportive way, replace coal-fired power plants with renewables is going to be an absolutely critical test. I think globally, we are still spending trillions of dollars on fossil fuel subsidies. And the single most important thing I would be looking at is not the credits that we give to renewables, not the penalties we impose on fossil fuels, but just the pace at which we reduce those fossil fuel subsidies.